Tahir, we have Pankaj Tibrewal also joining us. He's, of course, fund manager with Kotak AMC. And you'll want to hear Pankaj weigh in on the debate as well. He's on the cautious side. He's clearly on the cautious side. Pankaj, I don't know if you heard Tahir weigh in. He was saying that he doesn't want to look at indices themselves because they may lead you to wrong conclusions. He's looking at the economic cycle itself and where we are in the economic cycle, and that leads him to believe that perhaps there's more to go. He didn't say it in so many words, but I'm kind of expressing that view on his behalf. But he's constructive. That's the message. So explain to us, Pankaj, why you are kind of cautious, especially in the small caps, micro, mini caps, etc. Go
on. Good morning, Prashant. Yes, from a medium to long term, if you look at the data perspective, last 10 years, small cap has given 21% CAGR and mid caps have given 19% CAGR. And they have outperformed Nifty by a wide margin. So from a medium to long term, they continue to be wealth creating and one of the best performing across all equity classes. But our view is that cycles have become shorter and sharper. And to survive in the long term and create wealth in the long term, we need to be cognizant about the near as well as short term. And there we believe that mid and small caps, we need to be a little careful and cautious. And there are certain indicators which are pointing towards that. Number one, if you look at the earnings yield of large, mid, small, of across all profitable companies in all the three indices, they're almost trading at the same earnings yield. And for all your viewers, earning yield is nothing but 1 by P. And when you look at the earnings yield across the same segment, why to take additional risk in mid and small caps where the mortality rate is much higher than large caps? That's number one. Number two, if you look at, there's a disconnect between the profit distribution and market cap distribution right now. So mid and small caps as a percentage of, free float market cap is about 31%, nearing all-time highs. And when you look at the profit distribution, the top 100 companies of India, which are large caps, constitute 75% of profits, and mid and small cap constitutes 25% of the profits. So there seems to be some disconnect on the profit distribution versus market cap distribution as we see today. Third, if you look at the flows, has been extremely strong. And I think we need to be careful that people are looking at rear view mirror, looking at the past 3-year, 5-year, 10-year returns, and probably assuming that mid and small caps are the way to financial nirvana. But our advice is that please don't make mistakes right now, because somewhere 2017 still seems to be fresh in minds of all of us. And mistakes made in 2017 actually had repercussions in 2018 and 19. When I look at the entire space, yes, there are pockets of opportunity, but in the near term, we see that many market participants are focusing more on P&L rather than balance sheet and cash flows. And that's something which needs to be worried about. And hence, a lot of flows are coming to mid and small cap funds. In the last 6 months, more than 30,000 crores have flowed into mid and small cap funds. We have seen 1.9 million new folios being opened in small cap funds, and they are above their historical averages in terms of valuations. So yes, from a mid and long term, we continue to be positive, but there seems to be some kind of greed which is clearly visible in the near term, and one needs to be careful about it.
Got it. Absolutely. I agree completely that, there is some amount of euphoria that's kicked into the market. But Pankaj, very quickly, if you can, tell us what are the pockets that you feel one should move out of? I ask because there's so many that are doing well now, whether it's, defense, whether it's some of the power names. You have sugar that has come back in a big way. Which are the spaces that you feel are just fads at the moment, and perhaps you should book your profits if you have them?
Sonia, history always repeats itself, and we should not forget the learnings from the past. And the past cycles have suggested that what are the pockets one should avoid in this euphoric zone? One, as I mentioned, people are looking more at profit and loss account and probably not giving too much of focus on balance sheets and cash flows. I see many sectors, companies where they have not generated cash flows for a long period of time, even operating cash flow. Those stocks are trading at crazy multiples. just because the narrative for the medium to long term is very strong. I think one needs to be careful about that. Second, I am seeing a lot of sectors and companies where working capital tends to be very high. But today, the order inflow is so strong that people are not worried about working capital. Third, many sectors, companies where return on capital is lower than the cost of equity, I think people are getting excited. But sustainably, we have seen that these pockets should be avoided because from a wealth creation perspective, they are not the ones to bet on. So I think classic, same, investment philosophy we need to follow and make sure that we don't carried away by momentum in the near term. I think right now, quality anchoring is the most important part. Rather than worrying about too much of upside, I think one should be careful about downside protection, how the portfolio will behave if there's a drawdown or a consolidation in the market for a slightly longer term. Don't forget, calendar year to date, Nifty is up 9%, Bank Nifty is up 3.5%, but whereas mid and small caps are up between 27 to 30%. And many stocks, we have seen them multiplying. Money making can't be so easy. And hence, we believe that near term, one needs to be disciplined on asset allocation.